Good morning, everyone. Jason Jacoby here with the closing bell for October 27th. Hopefully everyone's having a good week. It has not been a good week in the stock market, to say the least. At the time of recording on Friday morning, all major indices are down about 2% or even a little bit more. The Dow and the Russell are both negative for the year. The Dow is down about 2.28%, again, at time of recording on Friday. And the Russell 2000 is down about almost 7.5%, which are your small cap companies, your small mom and pop shops, even though they're not mom and pop shops because they are still multi-million-dollar companies. But anyway, we have some interesting stuff for you this week. Big inflation report. We'll talk a little bit about oil and Chevron's purchase of Hess. We'll talk about GDP numbers for third quarter came out. So we'll talk about that, what this means. It's been a rough few weeks, to say the least, but let's dive right in to the closing bell. All right. So first thing we want to talk about here is 10-year treasury. Okay. And the correlation to the 30-year treasury rate, which we monitor as well. Okay. So this week, we actually had a deepening sell-off in the treasury note market, okay, pushing the 10-year T-note to above 5%. Now, it did settle back at about 4.8%, which is where it's currently sitting. And that 5% kind of resistance level is very key before we have a majority or a potential move even higher than the 5% ceiling, which is really important to hold. So let's talk a little bit about that, like what that means. So basically, yields increase when bond prices decline. So you have investors selling off again with rates where they're at. They're selling their current bonds at discounts to increase yields. That way they potentially maybe want to capitalize on a different asset class or want to raise cash, or they want to go into the market and buy a new 10-year treasury note with higher interest rates, a higher coupon payments. So again, there's multiple reasons to seeing this, but what we want to see is the 10-year treasury note. We want to see those bond yields stabilize because they go up really quickly. I mean, if you look at last year or at the beginning of this year, was 3.8% rate for a 10-year, 3.8%. We're up at almost 5. That's a big, big jump, 120 basis point jump. All right. So at this point, in the correlation to 30 years, so you look at the 30-year treasury rate as well, which is again 30-year treasuries. It's at about 5.01%, as you can see on the chart on the screen here, or if you're listening, it's at 5% as well. So a little bit higher than the 10. It's not inverted anymore, but the 30-year is sitting at 5%. So again, holding that 5% mark and seeing these long-term rates stabilize a little bit is going to be key, I think, for the equity markets as well, to get people to come back in and buy as well, because the risk premium right now, the spread on the earnings yield on the S&P 500 and what you're getting in treasuries is as small as it's been in quite a long time, I believe since the early 2000s. So we really want to see that 30-year hold tight, because if it runs north of 5 towards 6, that could spell bad news for the equity markets. Again, we're monitoring this. Don't think it could happen, especially with the data that came out, which we'll get into, the PCEs today, Personal Consumption Expenditure Report, which is the Fed's preferred inflation gauge, because it talks about income and spending. But again, we're kind of monitoring the Treasury situation. All right, so let's talk about oil. Drill, baby, drill. No, I'm just kidding. But in all seriousness, again, oil is a big part of the world. Okay. And I don't see that changing, going anywhere, especially with the amount of oil that's used to make electric car batteries as well. And again, this isn't a political statement. This is just common sense. I have nothing against people driving electric cars. If you enjoy that, or, you think you're doing your part for the environment, whatever you think. Again, this isn't a personal condemnation. This is just facts here. Okay. So, Chevron's making bets on oil. All right. So Chevron just announced, which again, you can read this in our newsletter as well if you want to be added to it and you're listening to our podcast here or watching this on YouTube or on our website. you could be added to our mailing list. If you go to boyerfs.com and scroll to the footer, the bottom of the homepage, you can actually subscribe to our newsletter on there, which is released weekly. So we talk about this in our newsletter, but Chevron actually acquired Hess Corporation in an all-stock deal valued at about $53 billion. Once you tag in liabilities a little bit, it's actually closer to $60 billion. So they're trying to combat the purchase by Exxon of Pioneer Natural Resources. So basically, they're just trying to be strategic at this point and keep up with Exxon. Now, what's interesting? So, oil and gas companies are robust, right? They're financially robust right now, huge earnings. Again, supply and demand, oil price per barrel has been a lot higher recently with supply cuts by OPEC. What's interesting about this deal? So again, what this chart kind of puts into perspective. So the forecasts and even historical comparisons since early 2021, you can see here, OPEC does about 35 million with an M, million barrels per day. Non-OPEC liquid refineries or gas companies, they actually do close to 70, and they're projected to do close to 70 million barrels per day, over double what OPEC can do. And why this Chevron purchase of Hess doubles down on this is because there's three partners. So off the coast of Guyana, there's an estimated 11 billion, that's with a B, barrels of oil and gas reserves. Okay, that are located off the coast of Guyana. I hope I'm pronouncing that right. I apologize if I'm not. There's three partners in the rights to that oil and gas reserves. Okay, it's Exxon. It's now Chevron, because Hess had a third share of that. So now it's Chevron's. So the two largest oil companies, gas companies in America. And the third is China's CNOOC. So those three, again, have a third share, 33% approximately of that 11 billion barrels of oil that's sitting off the coast of Guyana. So with that being said, again, we can be energy independent if we utilize our refineries, if we have them open, if we're actually drilling, which is going to take pressure off of inflation as well. And again, this is just based off of facts and numbers, okay, people? This isn't political whatsoever. But it's going to relieve a lot on the economy, and we can actually be a net exporter of energy as well, help out Europe, who's tied really closely to Russia, which obviously last winter, if you remember, their energy and their prices to heat their homes in the winter went up 400%. Okay. So just want to talk about that. That's some big news in the oil field, in the oil industry. And just to see where that goes will be quite interesting. But big purchase, almost $60 billion by Chevron of Hess. All right, so let's talk about GDP, third quarter GDP growth. All right, so forecasters estimate that the third quarter GDP was 4.9%. Okay, this is the first read. Okay, then they kind of go through it. They do an audit of the numbers multiple times. So this is the first reading, and it came in at 4.9%. That's insane, people. Okay. But not so insane when you take into account that consumer spending in the third quarter was skyrocketing, right? Well, I like to call it funflation, is because you got the COVID hangover. You have people that saved, in excess of 37% increase in household savings during COVID, during the pandemic, which now that has run out and people are starting to spend on credit. Delinquencies are going up. You're seeing the trend reverse in a not so good way, but consumer spending was still strong this summer, which is the third quarter. People were flying, going to concerts. Taylor Swift tickets were out insane, which I don't get personally, but people love her music and her productions. So people were paying almost $1,000 a ticket. Maybe some of you did or bought it for your sons or daughters, or which is crazy. But I know you love your kids, or maybe you just love her that much yourself. But anyway, so funflation was here. Consumer spending accounted for over half of that third quarter GDP number. What's really interesting, though, so I was actually at a lunch the other day with one of the top asset managers in the world. And they, so what they do is they go, around the world. They're the ones at the company's doorstep or in their conference room, their boardroom, talking to CEOs, CTOs, CIOs, CFOs, the C-suite executives about the company's innovation, what they're working on. They look at their books and records, audit them, to see if it's a good investment opportunity for their investors like you and I. So what was interesting is that one of the bond managers that we were talking to, she said, well, if you look at the third quarter GDP, which came out at 4.9%, what's interesting about that is if you remove the government stimulus, so all the stimulus, the government was basically, selling a lot of debt, of government debt to fund Ukraine, to fund staying open, to paying off their debts. With that stimulus that they received, the money they received for issuing that debt, again, at higher interest rates, people were clamoring for it. If you strip that out, if you remove the stimulus, GDP would have been negative the last 2 quarters. Quite interesting. So again, we measure recession. And again, this chart says, note 2022 was not a recession because consumer spending and non-residual investment was still growing. Again, it's up for debate, but technical definition, and I know a lot of things factor into that, but if you have two contractions, two contractionary periods in GDP growth, in GDP, two contractions in GDP, say that right, not growth, contraction, in 2 consecutive quarters, that's technically a recession. So again, I don't want to beat this, like a dead horse here. I really don't. Whether you believe it was or was not, 2 quarters usually means technically, at least when we were studying to be a financial advisor on the test, was 2 quarters of negative GDP. So with that being said, we would have actually had that this last 2 quarters, which, I mean, again, if you're looking at our economy, a labor market was strong. People were still spending, which again, I think is due to a lot of that stimulus and savings and people buying on credit, which could be artificial, which we should start seeing that slow down. We should start seeing that slow down, which will lead us into our next topic. But again, contributed a lot to this GDP was consumer spending. So again, to be seen. I think we're going to see the consumer starting to hurt a little bit more. I think we're going to see the economy slowing down, at least on the consumer side. Manufacturing actually went to expansionary territory above 50 on the ISM manufacturing index this past month, which is good, right? So again, they've been contractionary for quite a long time, which equals recessionary, but it's actually been quite positive this past month. So that's kind of that lagging industry has started to pick up a little bit. We should see services, which has been kind of the prop, the strong leg of the economy. We should start seeing that cool down as summer kind of has subsided here. We're in fall, it should slow down. Markets have kind of priced in higher for longer interest rates. That the Fed's not going to be cutting rates anytime soon. And then you're seeing the consumer start to get a little bit more worried because leading into this next topic, personal income actually lagged spending this past month for September. Okay. So people are spending more than they're making, which isn't good. Again, and they've run through, a majority of America is living paycheck to paycheck, has run through their savings, which is sad to say. But again, it's not like we're the U.S. government where, hey, we're just going to keep raising the debt ceiling and spending more than we're bringing in. That's not how the real world works, right? That's just not, and all of us consumers know that. So while you might be saying, oh, inflation seems like it's coming down, which it showed in this latest PCE report. If you look at the bottom right of the chart there, which we like to measure year over year, compare where we are from a month 1 year ago, it actually came down. So PCE came in at 3.4% for September from last September. And then core PCE, which excludes volatile food and energy costs, came in at 3.7, which was down from 3.8. So again, this might be a misprint. August PCE was actually, I believe, 3.9, unless they just audited that and lowered it. But I believe it was 3.9 for August, down to 3.4 for September. So again, inflation's slowly trending in the right direction. And you're saying, well, why am I still in my pocket? And when I go to the grocery store, why am I still paying 20% more for groceries? Or, my mom just told me the other day, she went grocery shopping and she doesn't eat very much. She'll tell you that herself. Hey, mom out there, if you're listening, but basically everyone's still spending more across the board on a lot of different things. from food to gas, especially if you're in California, to services, again, funflation. So again, we should start seeing that moderate again over the next year as people stop spending, and supply hopefully increases, which is how the economy works, supply and demand. A lot of services, not goods, but services have been in demand for quite a long time now. We should start to see that change a little bit and start to see some prices come down, hopefully, as people get a little bit more worried about their incomes and their spending and their budgets. So that's the last thing I wanted to touch on. Again, not as long as our usual. We're missing Mark on this week's closing bell. He's off saving the world, but we'll see him again next week. And if you have any questions, again, always an honor to serve you. If you're listening, you're a first-time listener, thanks so much for listening. If you're a continued listener or watcher of our videos, we love you. We're thankful for you. And again, if you have any questions, feel free to reach out, call, text, email, compliant texting. LPL, if you're listening, we're compliant, I promise. In all seriousness, let us know if you need anything, okay? Y'all have a great weekend. That's this edition of The Closing Bell. Jason Jacoby. We'll see you next week.